used to always say is you're never going to get over on a bank. You're never going to get over on a credit card company. And you're never going to get over on an insurance company. What do you think that means, Daniel?
Which one, me or him?
There's two.
Either one.
I mean,
Good answer, though. When you don't know the answer, throw the other guy in there. I like that. How many Daniels does it take to answer a question?
2, 4.
What do you think I meant by it, though, for real?
They're manipulated the system so that they win every time.
Okay.
So that they're the ones, you're signing their contract. So you have to follow by their rules, so they already set the rules.
There's a reason why in almost every city, the biggest buildings are always banks. They're always financial institutions. You're not going to get over. You're not going to figure out some trick to outsmart these guys, these companies. Okay? Now, you can use these companies. I'm not saying that you shouldn't, but you're not going to win. It doesn't work like that. Okay? So we'll go into the subject of purchasing a home, right? And I'm sure there are some homeowners in here or some people that have looked at homes before. Obviously, where we live, right? I always talk in the op meeting, right? You have to know where we live. This isn't North Carolina. This isn't Iowa. This isn't North Dakota. This is the DC Metro, right? You can rent apartments, $3,000 a month. Okay, so you have to make money. These are major purchases. You got to understand a little bit about it, or else you're going to go in and you're going to get steamrolled by an agent, by a mortgage company, by a bank, by a loan officer, by a real estate agent. So when you want to purchase a home, you have the okay, and I just trying to. So when purchasing a home, most people cannot purchase a home in cash, right? Now there are some people. I said most. There are some people that buy in cash. Right? I sat down with my neighbor one time, and he had just sold his house behind me. Right? He sold a company for conservatively 50 or 60 million. Right? That's what I saw on Google, because I know it. I mean, it was a transaction. You can Google him, right? And he sold his house for $3 million. He downsized, right? Because his kids went to college. He sold the house right behind me for $3 million, and he had to get something signed from the homeowners, right? So some a neighboring homeowner he had to get signed, and I was like, oh, so where are you moving? And he's like, oh, I'm moving, down the street. We got a little smaller place, 1.4 million. I was like, oh, how were the financing options? Oh, no, I paid in cash. He goes, I always pay in cash. Now, I'm not saying that's good or bad or whatever it is, but there are some people that pay in cash. Okay? But most people cannot. So you want to buy a home, right? And you can't pay in cash, you have to look at financing options. Right? So say, for example, you want to buy a $400,000 home. The most typical type of financing options are you put down 20%. That means you come to the table with a down payment of $80,000. So what are you borrowing? $320,000. Everybody follow me? So you can pay that back over typically 15 years or 180 months. Or 30 years, 360 months. So there's something called an amortization schedule. That is a schedule of payments. It refers to the process of paying off your mortgage with monthly payments. Theoretically, you'll make 360 equal payments, and then your mortgage will be paid off if you do a 30-year loan. Right, Xander, get your calculator out for me. So your payment has a breakdown. And the reason why it has a breakdown is because most people do not complete the 360 months. They sell the home before 30 years. They might change their mortgage, which is called a refinance. They refinance it. They start over or they change the terms. Refinance. That's why there is a schedule of how these payments are going to be applied. So your payment has a breakdown. Some goes to interest and some goes to principal. So the interest is what? The cost to borrow the money. How much did you borrow? $320,000. That's what you borrowed. You're going to have to pay the $320,000 back. That's called principal. Right? Interest is how much does it cost you to borrow the money? And so what the bank says is, listen, we will finance this money over 30 years to you, Alexis, based on your credit, your down payment, your W-2, your job, how long you've had a job, how much money you have in the bank. And we'll give you a schedule of payments if you can pay this off 360 months, right? And here's a simple, right? So if you did 320,000 financing, payment is $17.83 a month, okay? Now the breakdown of principal and interest is $385 goes to principal, $1,333 goes to interest. So in the beginning, it's not 50-50. Your first payment is heavy towards interest, right? So do 1717.83 times 360.
Times 360?
Yeah.
618,408.
Okay, so you borrowed 320.
Yep.
Right? You borrowed 320. But what did you pay? Say it again.
618,000.
618,000. Funny, this is not taught in math class. Right? You're going to learn the Pythagorean theorem. You're going to learn pi. But they don't teach you an amortization schedule. So you borrow 320. You got to pay that back. I get it. So they say, and they know how to appeal, right? Look, your payment is 17, and our mind works great. Wait a second, that's not. It's $400 a week. I can have this home. And you have the vision, right? My kids are running around the backyard. My wife, and I'll speak for me, right? My wife is happy. I can bring my parents over here. What a great kitchen, all these things, right? And you start thinking about it, and then you start justifying it. Okay, 17, that's not bad. And this is at I think I said 4.5% interest rate, whatever I said. So nothing crazy, high or low. It's a little low. Because average interest rates over the last 60, 70 years are about 7%. So I know people are saying they're very high. They're not very high, they just were very low. Now they're higher than the average, but Samir, what are they on 30 years? 7.5, 8?
8.
Just 8. So they're only 1% higher than the average. But we got so used to it. So we see the principal breakdown, right? 385 principal, 13. So this is a rule you'll learn, okay, in finance. There's a rule in financing, especially on the mortgage, called 50-25. Okay? I used to train on this all the time, so if you've been here, you know me, you're going to remember this. Luis, you know what the rule 50-25 is?
No, it's
Huh?
not. Kind of. I attempt like the first years the interest is like 50%, and then the principal is lesser, like 25%, and then at the latter years, the gross.
Yeah, that's true, but what's the rule of 50-25?
When you've paid off, when you've made 50% of the payments, you still owe 75% of
So-
the mortgage.
On a 360 payment mortgage, after you've paid for 15 years, 17, the balance that you owe is only 25% down. So if it's a $100,000 house and you pay 50% of the payments, you still owe 75. That's the math on a bank. Right? Theoretically, say if I make 50% of the payments, I owe 50%. No. You make 50% of payments, you owe 75. That's what you signed up for. You're not going to beat the bank. You signed hundreds of documents notarized. You're not going to beat them. This is in your contract. This is in, and they say this. Study the amortization schedule. Study the amortization schedule. People don't do it because they got the house, they got the keys, they got the picture on the gram. And remember, like for example, my friends just came back from Egypt, and they have different financing rules in different countries. In Egypt, the maximum you can finance a property is 5 years. All you get is 60 months. They don't have this debt crisis like we do. Australia just got introduced to a 30-year mortgage. Just. 15 is like, people think that's a big one in the world. 30? And now they're talking about going to 40. So after 50% of the payments, your balance has only gone down 25%. So I'm making this payment of 1717. There's something called the turnover date. The turnover date, okay, and I don't know the guy's name back there. I think he was trying to explain that. The turnover date is when the amount that I pay, more of the payment goes to principal versus interest. Right? See here, your first payment, $385 is principal, $1,333 is interest, right? So if I got a mortgage today, a 30-year, on January 21st, 2040 is the first payment. More of the money goes to principal versus interest. I was just playing around with the amortization. So that's 216 payments before more of your payment goes to principal. So if you pay, if you have a house, now the average person refinances their mortgage within 6 years. You're only paying interest, and you only paid loan origination fees, and you only paid loan officer fees and closing costs. That's all you finance. So it's like you're eating an ice cream cone, right? And you got 4 scoops. You got done with the first one. This is the principal, by the way. The ice cream's all the interest, the fees, the commissions, that's all that is. So once you pay then you refinance and you get like another one. Like a bigger one. I mean, after you're trying to pay down the house, are there times where it's appropriate to? Yeah, sure, there are. But study the contract. Because what are the agents going to do? They're going to sell you on, see, the way we finance and the way we borrow money, this is everybody. What's the rate? That's what we always say. What's the rate? 4.5, 3.99, 2.5. And rate is important. And then the second question we ask is, what's the payment? See, they don't say what Xander just said. To borrow this $320,000, you're paying, what was the number? $618,000. That's called the total cost. Now we can slice it and show it in monthly amounts, all that stuff, that's great. But what are you borrowing? What is the cost of borrowing? That's interest. Now you can show me a payment, you can show me a rate, but the cost is $618,000. Now you can do things to accelerate, right? Like if you can add money every month, that's called an accelerated principal payment. So if you can put an extra $500 towards your principal every month, right? You still have the interest, but then every month it's going right to principal. That's great. That's a way to accelerate your debt. Now, go to the next one. So, and I don't know if Samira remembers this, but someone give me an eraser.
I gave you a Sharpie.
Shondell, come in, wax on, wax off. All right. So, sometimes they have programs that save you money, right? They in their mind, right? It's not really saving you money, but this is called creative financing, right? So an interest-only mortgage says you only pay the interest, right? So you never pay the principal. Nah, that's cool. Thank you. So, in an interest-only mortgage, like say you have a very common one is a 10-year interest only. Okay? And so initially you say, man, we can get you in this house and we can save you some money. Well, it's going to make you a little bit easier. Your income's going to go up. You're going to make more money. You don't want to wait a few years because the housing prices are going up, interest rate. They give you this FOMO, right? You need to buy it right now. And look, I'm not telling people not to buy a home. I have a home. I'm not saying that. I'm just saying, read the contract, understand the financing options. That's all I'm saying. Because everybody has an agenda. Everybody's trying to get you to spend your money, but it's your money.
Right.
And you got to be smart. So they say, look, for 10 years you can save the interest only, right? And you save the $385 initially. Because remember I showed you that 17 payment. Only $385 is going towards principal. So now you're still paying 13 whatever it is, right? If you go back real quick. You're still paying $13.33. So you save the $385. But what happens after the 10 years? Now you have to pay over 20 years. And you re-amortize. So that means that now you have to pay the full principal and interest, but you only have 20 years to do it. So instead of 360, you got 240, and you still owe the 320,000. And we're going to use the current interest rates. And usually, it's a kind of Murphy's Law, the interest rates usually always go up. And so now, you have to pay $25.77. Say, it's okay, I'll just refinance. I'll get it from another bank. I'll get another, I'll do the whole mortgage and I'll start over again. Which, by the way, remember, all you paid was interest. All you paid was closing costs, fees to the broker, fees to the bank. But what happens? Is they always say the housing prices will go up. But they don't always go up. Sometimes they go down. And when interest rates go up, sometimes price values do go down. Now, it's weird here, But I was just talking to Samir, and he was telling me, he's like, man, you know, I just saw my neighbor, or a couple people down the street, or a couple people in our neighborhood, or a couple of our clients, and they had to reduce the price 3-4 times. Houses aren't selling like that because it's harder to qualify. Rates are up. And then what happens? Now, you owe the same amount, and your house is $20,000, $30,000, $40,000 below what you owe. So now if you want to refinance, you got to come to the table with $40,000, or you got to pay $2,500 a month. And if you can't do that, the bank comes and gets your house, and they already took 10 years of payments. 10 years. And you have zero equity. Actually, you have negative equity. You know, always check out like I always do this, right? You know, because I'm a little bit older than a lot of you guys, so. No, I'm serious. So, like the stadium names, right? They used to be like RCA Dome. Now they're SoFi Stadium. Quicken Loans Arena. Rocket Mortgage. Right? They all have, right? And now it's Capital One, right? I mean, like, think, they're all banks that own these stadiums, sponsoring them. You know, like, this is how. You got people paying $1,300 a month. You talk about a subscription? This ain't no, like, shared Netflix $22 premium. They're paying thousands, and $1,300 a month is a low payment, by the way. Now, this is a trick that they use, and this is very similar to insurance. Right, go to the next one. Oh, wait a minute. That's not it. All right. So, Samir, you'll remember this. Because we used to see this all. We have a lot of friends in banking and real estate, and, you know. And we do mortgages. I'm not saying that. It's just like, they don't care about clients, man. They don't care if the clients have home, you know, have a retirement account. You know, they're trying to peddle, right? And that's okay. I get it. You want to make money, awesome. But I know what people do, right? We sit down with these clients. We see the aftermath. So they outlawed this, but there was a trick they were using, especially in 2006, 7, and 8, okay? Where you could get a house based upon stated income. What was that? Samir, what's stated income?
You literally just tell them how much you make and they don't check.
They don't check. It wasn't verified. Stated income. All right? They didn't check your bank deposits, they didn't check your W-2s. Whatever you stated was your income, that's what they gave you credit for. So we saw people making combined $75,000, they're in a $900,000 home. No joke. And so this was the marketing tactic that the banks used. They used to have a thing, and it was called a 4-box close. Okay? And they gave you 4 payment options. All right? And the first one was a 15-year mortgage, principal and interest. Okay? And so in this example that I just showed you, $320,000 with a 20% down payment, so you're buying a $400,000 house, you're putting $80,000 into it. Okay? So your 15-year payment is $2,367. Think about that. You can pay for 15 years, you own almost a $500,000 house. That's the best option. Then they give you the 30-year. 30-year is $1,816. Okay? You talk about price conditioning, right? This house, $1,800. I'm renting an apartment. You know, I got neighbors banging on upstairs, and you know they're crazy. This, that. Right? That's what people think. I can get a house. I have a yard. My kids can play. They go to a good school. I get it. I understand. I'm a parent. But then they go interest only. $1,467. Oh yeah, I got this. I got this house. This is it. I got it. But then they had one other box. Okay? And there's something in the mortgage industry called negative amortization. What's negative am?
Means that you're never gonna make money, you're gonna owe more money.
It means that you're not even paying the interest. That's what negative amortization is. You're not paying the interest and your balance is growing because you're not even paying the interest. So if you owe $320, it's actually growing. But they didn't call it negative am because that doesn't sound great,
Yeah.
right? Samir, you remember what they called it?
Make a payment.
Minimum payment. They call it minimum payment. And the minimum payment is $1,000. So you got people that they're emotionally involved. They toured the house, right? I mean, I'm married, right? You tour the house. Man, this house is, my wife saying, man, this house is great. I love you for this. I haven't heard that in 10 years. I love you. Let's do it. Right, Rod? Sign. Daddy, is this gonna be my room? You don't think I've toured with kids, man. You know how hard that is for a dad? You're trying to do the right things financially, living below your means, saving money. So what happens is, in the contract it says once the payment goes to 115%, once the balance goes to 100, so you're not paying, you're adding $500, $600, $800 a month to the balance, and once it goes to 115%, so if it's $320,000, 115% of that, we'll call it $365,000. Now you got to pay all of it over the rest of the time, and now your payment goes to $2,510, which is worse than here, foreclosed. And I don't have time to do it today, but this is, in a weird way, this is how an IUL works. The same thing.
Yeah.
Standard payment, guaranteed, flexible premium. No, it's all bullshit.
Yeah.
You're not going to win on the insurance company.